The $174 billion. Secret: why Wall Street's smartest money is quietly loading XRP while you're still chasing memes. What's happening, crypto family? You know what absolutely blew my mind last week? I was deep diving into Federal Reserve cross-border payment data at 2 a.m. because that's apparently what I do for fun now when I stumbled across something that made me spit out my coffee. While everyone's been arguing about whether we're in a bull market or bear market, there's been a silent revolution happening right under our noses. And it's not another dog coin or AI token. It's XRP. Now, before you roll your eyes and think, here we go again with another XRP shield video, hear me out. Because what I'm about to show you isn't hopium. It's cold, hard institutional data that suggests we might be witnessing the most significant transformation in global finance since the creation of SWIFT itself. The August 2025 bombshell that changed everything. Let's start with the regulatory earthquake that shook the entire crypto space in August 2025. After 5 grueling years of legal warfare, Ripple Labs reached a landmark settlement with the SEC that fundamentally reclassified XRP as a digital commodity, placing it in the exact same regulatory category as Bitcoin and Ethereum. But here's the kicker. Ripple only paid $125 million in fines. To put that in perspective, that's less than what some hedge funds spend on office rent. More importantly, the SEC waived Ripple's bad actor disqualification under Regulation D, something they rarely do, signaling a complete shift in enforcement priorities. The market's immediate response was absolutely explosive. XRP surged to $3.32 before stabilizing around $3.14, with trading volumes exploding by 208% to $12.4 billion in a single day. But what happened next is what really caught my attention as someone who's been tracking institutional flows for years. The institutional accumulation that nobody's talking about. While retail traders were celebrating the price pump, something far more significant was happening behind the scenes. According to the latest institutional holdings data, large investors have accumulated $3.8 billion worth of XRP during market corrections throughout 2025. That's not a typo, $3.8 billion in smart money flowing into XRP, while most people were focused on the next Solana meme coin. But it gets even more interesting. Institutional ownership has climbed to 10.6% of XRP's circulating supply. To understand how massive that is, consider that Bitcoin's institutional ownership took years to reach similar levels, and that was with the backing of every major financial media outlet. The derivatives market tells an even more compelling story. CME XRP futures achieved a record $1 billion in open interest within just 3 months of the regulatory clarity. $1 billion. That's serious institutional firepower positioning for something big. The infrastructure play that makes Amazon look small. Here's where this story gets absolutely wild. While everyone's debating whether XRP is a security or not, Ripple has been quietly building the most comprehensive cross-border payment network on the planet. Their on-demand liquidity service processed $1.3 trillion with a T in cross-border transactions in Q2 2025 alone. Let me put that number in perspective for you. That's more than the GDP of most countries. That's more transaction volume than many traditional payment processors handle in an entire year. And it's all flowing through XRP rails. RippleNet now serves over 300 financial institutions across more than 40 countries. We're not talking about small credit unions here. This network includes Santander, Standard Chartered, SBI Holdings, American Express, and PNC Bank. These are Tier 1 institutions that move trillions of dollars annually. But here's the part that made my jaw drop. Standard Chartered's integration reduced settlement times from 48 hours to under 5 seconds, while cutting transaction costs by up to 70% compared to traditional SWIFT transfers. 70%! Imagine cutting your monthly expenses by 70%. That's the kind of efficiency gain that makes CFOs wake up in the middle of the night with excitement. The SWIFT integration that changes the game forever. Now, here's where this story takes a turn that even I didn't see coming. SWIFT, the 11000 institution messaging monopoly that processes $6 trillion daily, has begun testing XRP in live trials set to begin in late 2025. Think about what this means for a second. Instead of trying to replace Swift's messaging network, Ripple is positioning XRP as the liquidity layer that complements existing infrastructure. Swift handles the messaging, XRP handles the instant settlement and liquidity sourcing. This hybrid approach is absolutely genius from a strategic standpoint. Rather than forcing banks to choose between Swift and Ripple, they're creating a model where both systems work together. Swift's ubiquitous messaging paired with XRP's on-demand liquidity. If these trials succeed, we're looking at XRP potentially capturing a significant share of Swift's $6 trillion per day cross-border payment flow. Even capturing 1% of that volume would be transformational for XRP's utility and, consequently, its price. The ETF tsunami that's about to hit. The regulatory clarity has unleashed something I've been predicting for months, a tsunami of institutional investment products. 11 major asset managers have filed XRP ETF applications, including the heavy hitters, Grayscale, Franklin Templeton, Bitwise, WisdomTree, and 2-1 shares. Bloomberg analysts are assigning a 95% approval probability for at least one XRP ETF by Q4 2025. That's not speculation, that's institutional research from analysts who've been right about Bitcoin and Ethereum ETF approvals. ProShares already launched their leveraged XRP ETF, which is managing over $1.2 billion in assets. JP Morgan is projecting $5 to $8 billion in first-year capital inflows once spot XRP ETFs get approved. That's institutional money that will need to buy actual XRP tokens to back these ETFs. The technical foundation that leaves competitors in the dust. Let's talk about the technology for a minute, because this is where XRP's competitive moat becomes crystal clear. The XRP ledger processes 1,500 transactions per second with settlement finality in 3 to 5 seconds and fees below $0.01 per transaction. Compare that to Bitcoin's 7 transactions per second with 10 to 60 minute settlement times and fees that can spike to $50 during network congestion. Or Ethereum's 30 transactions per second with unpredictable gas fees that have reached over $100 during peak usage. But here's the environmental angle that's becoming increasingly important for institutional adoption. XRP's consensus algorithm consumes 0.0079 kilowatt hours per transaction. That's 57000 times more energy efficient than Bitcoin. When BlackRock and other ESG-focused institutions are evaluating blockchain infrastructure, energy efficiency isn't just a nice-to-have, it's a requirement. The CBDC interoperability play that's worth trillions. Here's where this story gets really exciting. Central banks around the world are racing to launch CBDCs, and XRP is positioning itself as the universal bridge that connects them all. Ripple is actively working with central banks in Palau, Bhutan, and several Caribbean and African nations on CBDC pilots. But this isn't just about small island nations. The implications are massive when you consider that over 70% of central banks are now testing or piloting digital currencies. Think about the math here. If even a fraction of the world's CBDCs use XRP as their interoperability layer, we're talking about settlement volume that could dwarf current cryptocurrency markets entirely. The whale accumulation data that tells the real story. Now let me share some data that absolutely shocked me when I first saw it. Whale accumulation wallets holding more than 1 million XRP reached 340 million XRP in just 2 weeks during mid-2025. That's over $1 billion worth of XRP moving into strong hands. But here's the really telling part. $268 million in XRP moved off centralized exchanges into institutional custody solutions during the same period. This isn't retail FOMO, this is sophisticated money positioning for long-term holds. When institutions move assets off exchanges and into cold storage, they're not planning to trade it next week. They're positioning for multi-year holds based on fundamental utility, not short-term price movements. And you guys, I have a special trick for you which nobody seems to be using, and I cannot wrap my head around why. Because if you sign up through my link down in the description onto the BuyDefi exchange, you get a 10% deposit bonus, and now stay with me here. Now, here comes the important part. If you have any trading capital on any other exchange, and you move it to your newly created BuyDefi account, you get on top of your capital. You moved another 10% extra trading capital. As an example, if you move or deposit $10,000 to your account, you get a $1,000 for free. And here is why this is possible. Buy DeFi makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, Buy DeFi's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video. Alright, let's jump back into the video. The market cap asymmetry that creates generational opportunities. Here's where the math gets really interesting. XRP's current market cap sits around $170 billion, while Bitcoin's exceeds $1 trillion and Ethereum hovers around $400 billion. But here's the thing. XRP's total addressable market cross-border payments, remittances, and CBDC interoperability exceeds tens of trillions of dollars annually. That's not hyperbole, that's the actual size of the global payments market that XRP is targeting. Meanwhile, Bitcoin's primary use case remains digital gold, and Ethereum focuses on smart contracts and DeFi. XRP is going after the foundational layer of how money moves globally. The technical analysis that points to explosive moves ahead. From a technical perspective, XRP has been trading in a tight consolidation range between $2.70 and $3.20 throughout late 2025. The 200-day exponential moving average is providing strong support around $2.50 to $2.60, which aligns perfectly with known institutional accumulation zones. What's particularly interesting is that breakout above key resistance at $3.10 historically coincides with major partnership announcements or regulatory developments. If ETF approvals align with positive SWIFT trial outcomes, technical analysis suggests a move toward $4.00 and potentially much higher. The environmental sustainability angle that institutions love. Here's an angle that doesn't get enough attention but is absolutely crucial for institutional adoption. While Bitcoin mining consumes approximately 173 terawatt hours annually, roughly equivalent to the energy consumption of Ukraine, XRP's annual energy consumption equals powering just 50 US households. Ripple has committed to carbon net zero operations by 2030 and has funded 12 environmental initiatives through a $100 million carbon fund. Over 90% of new validator nodes are now running on renewable energy. When pension funds and sovereign wealth funds are evaluating blockchain investments, ESG compliance isn't optional, it's mandatory. XRP's sustainability profile gives it a massive advantage over proof-of-work alternatives, the real-world impact that goes beyond price. Let me share a story that really drives home XRP's real-world utility. A European healthcare supplier began using ODL in mid-2025 to settle payments between their German manufacturing base and Turkish distribution network. By routing payments through XRP, they reduced currency exchange latency from 2 business days to under 1 minute and cut FX slippage by 1.2% per transaction, saving over $4 million annually. That's not a blockchain proof of concept or a pilot program. That's a real company saving real money through XRP utility. Multiply that across thousands of similar use cases, and you start to understand the massive economic impact XRP is creating. The Amazon parallel that explains everything. Remember Amazon in the late 1990 seconds? The stock traded sideways for years, while Bezos quietly built the logistics infrastructure that would eventually dominate global commerce. Everyone focused on book sales while missing the bigger picture. Amazon was constructing the backbone of e-commerce. XRP is following an identical playbook. While traders focus on daily price movements, Ripple has spent over a decade building regulatory, relationships, institutional partnerships, and technical infrastructure that positions XRP as the backbone of global value transfer. The difference is that Amazon faced competition from traditional retailers. XRP is competing against correspondent banking relationships established in the 1960 seconds using technology designed for the telegraph era. The regulatory convergence that seals the deal. We're witnessing unprecedented regulatory convergence around digital assets. The EU's MiCA framework explicitly recognizes settlement tokens like XRP. Asian jurisdictions from Japan to Singapore have established clear custody frameworks. New York's updated bit license specifically acknowledges XRP as a permissible digital asset. This isn't random, it's coordinated recognition that digital settlement rails are becoming essential infrastructure for the global economy. Why this moment is different? Look, I've been in this space long enough to see countless "this time is different" moments that weren't actually different. But the convergence of regulatory clarity, institutional adoption, technical utility, and macroeconomic necessity creates a perfect storm that's genuinely unprecedented. XRP isn't chasing market trends, it's defining the infrastructure where $50 trillion in daily global value transfer will eventually flow. By 2030, sending money internationally will be as mundane as sending an email, and the blockchain rails powering that transformation will be very visible in XRP's price. The investment thesis that writes itself. Here's the bottom line. We're not early to crypto anymore, but we're incredibly early to the transition where crypto becomes indistinguishable from traditional finance. XRP isn't just a digital asset, it's becoming critical infrastructure for a tokenized global economy. Standard Chartered's research projects XRP reaching $12.50 by 2028, based purely on institutional adoption metrics. But those models don't account for CBDC interoperability multiplier effects or explosive asset tokenization growth. The current price range of $2.80 to $3.20 may represent the last opportunity to accumulate before mainstream institutional adoption drives XRP into double-digit territory. Your move. The infrastructure is being built right now. The partnerships are forming. The regulatory framework is crystallizing. When this financial plumbing goes live at scale, XRP won't be trading at today's prices. It'll be priced as the backbone of global financial settlement. Ready to position yourself before the world's financial infrastructure gets its biggest upgrade since the invention of banking? Smash that like button harder than central banks are, smashing CBDC pilot programs. Subscribe like institutional money is subscribing to XRP utility. And ring that notification bell so you don't miss our next deep dive into exactly which corridors are going live and what that means for early adopters who recognized infrastructure over speculation. The future of money is being built right now. Don't let this generational opportunity slip through your fingers while everyone else is distracted by the noise. I'll see you in the next one, where we're breaking down the exact timeline for CBDC rollouts and why XRP holders are positioning themselves at the center of the biggest financial transformation in human history. Peace out. And remember, we're not just investing in tokens, we're investing in the future of human coordination itself.